you need to make sure that as you go through the process, you've negotiated all these things right. Then when you go to FID, final investment decision, raising equity and raising debt is easy, right, at that point, because you've done everything right.
Welcome to the Climate Tech 360 podcast, where we connect with diverse voices in the climate sector to make informed choices in supporting the future of climate technologies. I'm your host, Samia, and today I'm speaking with Jeremiah Lim, a director in Barclays' Sustainable and Impact Investment Banking Group, where he advises climate technology clients on innovative financing solutions. Jeremiah has had a number of roles at Barclays, where he's been for almost a decade, including senior roles in the ESG structuring and the securitization and structured finance groups. But let me just step back for a second. If you have no idea what terms like securitization and structured finance means, that's okay. This episode is for any climate tech founder that wants to raise debt. Specifically, we get into details around project finance, but if you're a climate tech founder that wants to raise debt of any kind, the information that we discuss in today's episode will be useful to you. And we start with the very basics, namely, what is debt? Why does debt require steady cash flows and security? What do banks look for before issuing project finance? And specific examples of deals that Barclays worked on in the climate and clean tech space. Actually, the most insightful part of the conversation for me, and possibly for listeners who are early stage climate tech founders, was when we spoke about the commercial challenges of scaling some of these technologies, because Jeremiah has been through the full life cycle of working with some of these companies as they scale from pilot projects into much larger commercial operations. The European climate tech community is very collaborative and close-knit. So chances are you've probably met Jeremiah or heard him speak at a conference, because he has very much become a go-to authority on project finance for climate. And he's a gift of explaining some very complex concepts in a way that everyone can understand. This is the first episode in a series that I've recorded around the topic of financing hardtech climate startups. And I think it's a great starting point for both founders and investors who are thinking about how to use debt to commercially scale their business. And now onto the episode. Welcome, Jeremiah.
Thank you for having me.
Thanks for being here. I'm excited to chat about your background and everything that you know and share it with basically everyone that's interested in trying to figure out how to finance some of these climate tech hardware companies. So you and I have just finished attending a bunch of conferences that sort of started in the summer and ended in the fall, all on climate tech. And the number one topic was, how do we finance hardware companies? Because the venture model has historically been used to invest in software companies that don't have any debt. And what we're looking at here is a lot of sort of early stage technologies haven't been proven from a technology readiness standpoint. It's very early, and they are CapEx heavy, and some of them are even infrastructure projects. So it begs the question of, how do we scale and finance these companies? And do models even exist to finance them, or are we going to have to create new ones?
Thank you very much for having me in that introduction. It's really good to talk about it because it is a bit of the elephant in the room, isn't it, at this stage? We need to scale up so rapidly to hit these net zero targets. And we really need kind of hardware, as you say, or real infrastructure in our words, to get there. You don't get to net zero with
just software,
right?
Exactly.
I mean, there are some efficiencies, and absolutely we should be doing those as well. We should be throwing the kitchen sink at it. But that includes, direct air capture. That includes physical hardware to capture carbon at point of source. And these are real infrastructure projects that need real people building real stuff.
Yeah.
Unfortunately.
Yeah. So your background is on the project finance side. You have experience with financing large sort of CapEx heavy projects with debt. Let's assume that anyone listening, they have no understanding of debt, so we can take it from the most basic level. But what is project finance?
Yeah. Maybe we could even start with what is debt.
Debt? Yeah, let's do it.
Because you'd be surprised how many times I get that question with these CDR startups.
Yeah.
Because, they've never faced that before.
Right.
And it's very different lending to a company versus lending to you against your mortgage, although that's a pretty good starting point. So that really it's a stream of cash flows that you're securing against. And as a lender, the primary goal is not to make a windfall. The primary goal is to get your money back.
Right.
So we really look at this with a lens of, does that company have serviceable cash flows, in the words of a debt financier? And how do those cash flows get secured and ultimately how can they be used and ring fenced to pay back the debt? Because ultimately, as a lender, you're not getting the upside on the company IPOing or scaling up really rapidly. All you get back at the end of the day is the face value of your debt plus some interest pre-agreed up front. That's the reason why debt is cheaper than equity, but that's also why it's a lot less risk inclined.
And what about the collateral element?
The security is one means of securing your cash flows. That's a good, the way that we usually explain it to clients are debt can be secured on contracts. So it could be that, somebody, your off-taker, if you're a direct air capture company, the likes of, your large tech companies, Microsoft, Stripes, etc., they could agree to pay for some of that carbon removed. It could be security against the equipment that you buy, if that equipment has secondary value. As you alluded to, the collateral value of that can be used in the event that you go insolvent, and the lender needs to enforce against that security. Like, that's the predominant, to be honest, comfort that you take in a mortgage, right? Your house is the security value essentially, and you liquidate your house. And then, it could be other stuff like intellectual property, if that's valued and again has good secondary value. Although I would caveat in that case that intellectual property is very hard to make a good judgment call on how much it's worth. And secondarily, there's usually some selection bias with regards to when you go insolvent and how much your intellectual property is worth.
Yeah. And that's here, you're looking mostly at offtake agreements because there really is no collateral, right? Like going back to your example of the direct air capture, which is basically just technology that sucks carbon dioxide out of the air. But what would you even do with that equipment? It's not like a house where you could resell it. So you're not really, from a debt perspective, looking at, okay, if this company goes bankrupt, we can sell off their assets. You're looking at those long-term offtake agreements, right?
Exactly. I think you're looking at it the right way. If you build a direct air capture facility somewhere in the middle of nowhere, that land is probably a small fraction of what the entire plant costs. A lot of it actually is engineering work, candidly. So your basic engineering design of the plant, actual kind of construction work, so paying people to build it. And a lot of the equipment installed on site are special purpose equipment that can't really be sold and used for other stuff, right? It's, specialized fans, heat exchangers that are customized for your specific specs of the facility and so on. You're very unlikely to be able to sell that in the secondary market for a good value because it's customized to one particular use. It's very different from a car, for example, where there is a liquid secondary market. So I agree with you. It's largely based on offtakes. And those offtakes, again, have to be structured in the right way to be financeable. I think that's where we're struggling as an industry today and having those conversations.
And then the types of debt that these companies take on, are there other flavors other than project finance? If you have these offtake agreements, are there other types of debt that they can get, or is it mostly just project finance?
So taking half a step back, project finance is a toolkit, not a kind of defined product, right? And it sits within a wider toolkit of what we call structured finance bulks or non-recourse finance bulks. And that really is a range of different techniques rather than an off-the-shelf product.
So can you give us examples?
Yeah, of course. It isn't like a mortgage agreement where you basically fill in the blanks. It's all customized for the specific project characteristics and the client characteristics. So you're really looking at designing a debt product around the client and around what they're building and what they're asking for. So when we say project finance, we use that pretty loosely in this industry. But really, the art, if you like, of structured finance or project finance is ring fencing a pool of cash flows. So in our words, we use the term non-recourse a lot, and that's what it means, ring fencing it from the borrower and making sure that string of cash flows and assets are used to repay the debt first, therefore de-risking it slightly from the overall borrower's credit characteristics.
Right.
So a lot of these companies, as you say, are startups, right? And typically for you to lend against a company, they have to be credit worthy. Often, if you can take debt at a company level, that's the easier way to go. But often these companies are not credit worthy. They don't have a track record. They don't have profitability or operating cash flows to support debt, right? So you need to ring fence a pool of cash flows as part of that company. It could be current, it could be future, to repay some amount of debt. And that's where this project and structured financing lens comes in. Then when you look at these projects, call it that, or the ring fence pool of cash flows, you're looking at different techniques to de-risk it often, because they're still very risky. And that's when you look at structuring offtakes in the right way. That's where you look at subordination in the right way, or securitization in the right way. That's where you look at different techniques to manage construction risk and do risk sharing with different parties that ultimately, hopefully, touch wood, make some of these projects financeable.
So let's go back to your previous example. If you're a direct air capture company and you have this agreement with Microsoft where they are going to buy removals for you for the next, I don't know how long these contracts are, 5 years or something, at a price of $300 a ton. You're smiling, so I don't know if that's even realistic. And then they come to you and because they want to expand, and it's very CapEx intensive, and so they need some debt so that they can build new DAC facilities. What would happen then? I don't know if you guys have even worked on a DAC project, but I'm just using it as a theoretical example. We could talk about something that you've done before as well.
Yeah, no, I think that's probably a good counterfactual. And then maybe we can talk about live examples where I think are more financeable. Mm-hmm. So that is really challenging, because even if Microsoft do enter into a contractual arrangement with you, and Annie and Katie are fantastic with regards to that, Microsoft will pay if you can deliver them carbon credits. So Annie's not writing you a blank check right now and giving you money to build a DAC facility. She's saying,
you already have that facility.
Yeah, you have a facility, or you're building a facility, and we will pay you when you've hit certain milestones, i.e. deliver me some carbon removals, right? And that puts execution risk, construction risk, project operation risk on the company itself. So as a lender, you need to get comfortable, not just that Microsoft will pay, which we're pretty confident Microsoft will pay. They're a large company. As long as that contract is robust, we're pretty sure that they'll pay out. But the risk really is on the company delivering what they said they would deliver. And in the case of that involves building a gigantic, essentially a gigantic facility with enormous fans, a lot of corrosive chemicals, and often vacuum swinging regeneration stacks sitting behind that. And that's not an easy feat. If the company hasn't done it before, then we need to look at the contractual arrangements on how they're getting there. So look at the engineering agreements, right? So do they have a reputable engineering partner? For example, like a Fluor or a KBR, somebody who's willing to take the risk of construction, who's confident, they've looked at the technology and said, I'm willing to stand behind this. I will provide you an EPC engineering, procurement, and construction contract that wraps everything. So I'm on risk for the delivery on time and on budget. If you don't have that from a reputable engineering company, it's very difficult to give any credence to that if you haven't proven you can actually build that facility, because you don't know what you don't know. Right?
So this is a kind of chicken and the egg situation, right? Because let's just say you start out as direct air capture company, you've raised your pre-seed, you've done a pilot, so you have one plant. And then you get an offtake agreement. It would be against that one plant. And then you would raise the debt to build another plant. Is that correct?
Yeah. I mean, a lot of these companies don't even have that one plant, right? Yeah. Or that one plant is subscale, not enough to deliver the amount of credits that they need to finance against these offtake contracts. So the reality is they need to prove, yes, the subscale kind of commercial prototype type plants, and they need to scale up to build bigger plants in order to fulfill these offtake agreements. And that's really where the pain point comes in, right? investors like yourselves within the climate tech space in venture capital are willing to invest in 50 million, maybe even 100 million prototype facility to prove out a concept when the technology is good. But what you struggle with, or what a lot of companies struggle with, is building out that first large, we call it utility scale facility. So these are hundreds of megawatts equivalent of DAC, in terms of power utilization, or even a gigawatt of DAC, rather than these 10, 50 megawatt plants. I'm using the energetic equivalent, but you can backsolve for millions of tons per year. Ultimately, for these plants to scale up, or for DACs to scale up, we need really for the proposition to be de-risked, right? Meaning from a construction perspective, from an engineering perspective, these large engineers need to get comfortable with building these plants, or you need to prove that you have a track record in building it. If you want to do it in-house, you need to show the market that you're scaling up and you know what you're doing. It's very difficult to say to a uni startup or a founder who's never really run an industrial operation, prove to me how you can run this facility, because there are a lot of kind of practical challenges that you don't know what you don't know until you actually do it.
Yeah, we talked about this earlier when we were grabbing coffee, but I look at a lot of these technologies and yes, they're at technology readiness stage of, 2 or 3 when they come to us. But at some point they get to that later stage and it's still a very either an experienced team or a team of scientists. And what these things are is really, they need people with commercial expertise of scaling very large things.
Yes.
And we were talking just even about like safety risks and how important those things are, and then operational risk. Like, do they know how to operate it? Do they know how to fix it? Do they know how to keep their employees safe? Yeah, and
absolutely.
That's where we need more people. We need more people from I think from some of these oil and gas industries that are used to scaling these large projects, moving into climate.
I'm glad you said that, because I hate to say it, but ultimately, a lot of the engineers from these oil and gas rigs, they know how to operate these kind of hazardous materials on site, right? And a lot of running a plant for 10,000 hours a year, whatever the number is about fixing problems, practical challenges as they come. Like, what happens to your vacuum swing regeneration unit when it breaks down? Like, if there's, dust that causes a clog or a jam with the mechanical system? What happens when, there's a leakage with your, potassium chloride, potassium hydroxide solvent? What happens when your fan breaks down because a bird flies in? All these things happen on the ground. And unless you have a level of expertise running these large scale utilities, it's very difficult to lend against that, because you haven't actually proven how to run these large scale facilities. And remember, we're not talking about 10, $50 million constructions. These are hundreds of millions or billions in DAC facilities for untested technology.
Yeah.
That that hasn't been run at this scale before, period.
Yeah. When you look at the big direct air capture companies like Climeworks or Carbon Engineering, they've raised a lot of equity and just equity. So it sounds like that's what they have to do initially before they can even think about getting a lender to issue them debt.
I think there are multiple ways of skinning a cat, and that's definitely a route to doing it. I think there are other companies like Mission Zero, just to give Nick and Duncan a shout out.
Great company.
Yeah, great company. I think we all really like them.
Yeah, and DSV is the best.
Exactly. And companies like that, they might be interesting from a different perspective, right? Where it's modular and it's easier to scale out a modular technology when you're rinse and repeating stacks rather than scaling up in terms of building a bigger
Something
and bigger
new.
unit.
Yeah.
Right. And, this comes back to the challenge we talked about earlier today, where when you're scaling up a gasifier, let's just say, if you're building two, whatever, like 2 meter diameter barrels versus one 6 meter diameter barrel, that's very different propositions, and it's very different practical challenges that you have to deal with, because the 2 meter diameter barrel, right, for gasification, right, if you're building multiple instances of it, the logistics, the engineering around it. Your mill that builds it has been kitted out for that barrel. The roads, the supply chain that can be utilized multiple times for that barrel.
Right.
But when you move to 6 meters, you don't know what you don't know. People don't realize that 6 meter barrel actually can't physically go on a road, right? And you need specialized equipment to ship it, to transport it to site. The installation might not work. You might have height restrictions with that barrel because it can't actually even fit within, it can't go under a highway. It can't go over a bridge, because it's just too big. And the installation of that is very different as well. The type of welder that you need is a different class and expertise of welder from a 2 diameter barrel. And that's just the barrel.
Yeah.
That's just
one component.
Yeah, that's just one component of it. Whereas if you're modular, you effectively plug and play multiple instances. Yes, it might not be as cost efficient scale wise, right? But in terms of deliverability, you have a higher confidence that Nick and Duncan can install 5 DAC stacks next to each other versus one super massive one.
Yeah. And that's really their value proposition. And for we see a lot of direct air capture, new technologies, and you have the removal, taking carbon dioxide out of the air, and then you have the regeneration side, which is the side that requires the most energy. And what we always see time and time again are companies that come to us and say, we have a new way to remove carbon dioxide from the atmosphere. It's a new technology. And you're not thinking through that whole supply chain process and everything that goes into commercially scaling, which is the bulk of what this is, right? So can you give us an example? I mean, this was kind of a theoretical thing, and direct air capture is still very much in its early days. Can you give us an example of something that you have worked on where you have issued debt? It doesn't, you don't have to name the company or anything, but in terms of, okay, you looked at this company, the offtake agreements were structured the right way. You can give us some examples of why that was, and therefore you were comfortable issuing debt against it.
Yeah, I think biochar is fundamentally debt financeable.
Yes, yeah.
Today, right? I mean, I say that with a lot of caveats, and the project has to be structured right.
Yeah.
Right. But I fundamentally think biochar, even enhanced rock weathering, is becoming debt financeable in the near term future. And the reason why I say that is there are large scale biochar refineries today. It's a bit biased, and because they're a client of ours, but Carbonex, or now known as Solaire, in France, they do have biochar refineries that are working in France today. They're producing biochar. They know how to run the facilities. They've proven they have an operational track record, and they have off-takers. So to your point, the big tick boxes around that. And the way that you will structure debt financing against that is looking through their operational track record, looking at that they know, or they can prove they know what they're doing, and B, as they're scaling up. So for a company like Carbonex, Soda, for example, they have a proven track record of operating large-scale biorefineries, and they have offtake contracts, right? So
how long are these? Can you talk a little bit about the offtake contracts? Like, what length would you look for? I would assume like a 1 year or 2 year is not enough.
Yeah, absolutely. One or 2 years, absolutely not enough. You're looking at offtake contracts that really are sufficient to amortize the debt. So if you have a biorefinery that requires a certain amount of debt, and that needs to be amortized over 7 years, you need an offtake contract for 7 years. So working round numbers, right? If your facility costs 100 million, for argument's sake, you want to take 50 of that, right? Your offtake contract needs to have revenues, or needs to yield you revenues, such that that 50 million of debt over 7 years, that's 7 million debt repayment per year. Your offtake contract needs to cover that and the interest.
Right.
Effectively, when you're working around numbers, that's what you're working with. And that's after, paying your staff, your feedstock costs, the cost of operating and maintaining the facility and stuff like that. So really, you're looking at kind of pretty chunky offtakes for a large part of the output of your facility.
And are you looking at it on a facility by facility basis? Because for biochar, usually you co-locate on site. There's a pyrolysis machine that's very expensive. And so let's just say they have one site. Would they be raising debt for a brand new site? Is that how it works?
Yeah, it could be financing the existing site. It could be a combination of financing the existing site and building a new site, or it could be just a new site. Ultimately, it depends on how your projects are structured, and how your offtakes are structured. So if your offtake contract is with the company itself, so in the case of CarbonX, with CarbonX, and you're allowed to deliver biochar from any refinery you want, then yeah, we could finance a bunch of pyrolyzers at a go. And ultimately then it becomes a structuring question of how do you optimize your debt? How do you kind of maximize the debt carrying capacity of that project? And when I use the word project, I really just mean what sits within the parameters of being financed by debt. And you can cycle through your facilities to try to secure your debt against what's operating, but use the use of proceeds, so where the debt money goes is used to finance new facilities. So you kind of do things in a smart way that optimizes how much you can borrow against.
And so what kind of due diligence would you do for something like that? And how long would it take? And what are you looking for? You talked a little bit about the commercial expertise, because I do know with pyrolysis machines, they are difficult to operate.
Hard there's a thing.
Yeah,
Yep.
it's a
and
difficult.
fly ash, and yeah.
And I've talked to a lot of startups in the biochar space, and they theoretically it sounds like it's easy to operate, but it's very difficult. And then also even securing those machines are really hard.
Yep.
People are waiting sometimes 18 months for a new pyrolysis machine. So what kind of due diligence are you doing on a project like that?
Yeah, of course. I think you've highlighted some of the key challenges, right? It's understanding whether the company knows how to operate a pyrolysis machine. It's knowing how to deal with tar buildup and fly ash and all that kind of good stuff. And even from the pre-treatment of the wood, because often these machines require certain, water content before it can go in. So making sure that they have processes in place or know how to deal with that from the waste wood feedstock. And it doesn't have to be the company itself. They could hire a third party to do it. Oftentimes, startup companies, you require some level of handholding at the start, right? How do you learn what you don't know if you've never done it before? You hire somebody who has done it before, right?
Do you prefer that? Because you talked a lot about risk sharing along the value chain. So sometimes, is that what you look for?
Yes, I mean, that would be part of it, right? If the company doesn't already have engineers and plant operators who know how to operate these large-scale facilities, we are absolutely expecting them to hire the right third party to show them how to do it. Because otherwise, how do you know that if I gave you, 50 million, 100 million to buy a pyrolyzer, how do I know you won't break it on day two? Right? Because ultimately, debt repayment happens over multi years for you operating that plant at, again, 1,000, 10,000 hours a year. That's a lot of operating capability. So, having a third party gives some degree of comfort. That third party obviously has to be reputable and have a proven track record themselves. But ultimately, yes, the answer is yes. Ideally, they have a partner that knows what they're doing. Then you look at the engineering of it as well, right? It's, operating really is at the end after the plant is in place and working. Again, engineering and construction is not an easy job. Even if you're building a pyrolyzer from someone like a Pyrec, and we really like the Pyrec team, by the way, this is a side point. Even if you're buying a modular one like that, you need to install it inside. You need, grid interconnection. You need the ability to kind of load up your wood feedstock and load the right kind of feedstock. And you need to, install it effectively. That's not an easy job. And somebody needs to do that engineering. If you're doing it in-house, that's fine. But again, you need that engineering capability, right? You need to prove you've done a feed study before. Feed is front-end engineering design. You need to show you've done basic engineering designs before and your plans have worked, right? It's no good to us having a theoretical exercise at this point, because it's a real plant with potentially real challenges that, people could get injured or worse, die if the plant wasn't engineered right or to spec. Because again, these are big, high heat facilities that operate at whatever, in the case of pyrolyzer, 800 degrees.
Yeah.
People could get hurt. So we need to make sure that as a person doing the installation and engineering for that knows what they're doing. That's the key part of it. Like, ultimately, it's across the value chain, across the project, making sure people know that these are real assets. You're playing with real lives here. And a lot of money is going into this project, is making sure that they know what they're doing, essentially.
And then also the credibility of the counterparty for the offtake agreements?
Yeah, I think it's the credibility. On the offtake side, is definitely credibility is one of it. Having a high creditworthy offtaker is part of it. Making sure that the offtake is, in industry terms, take or pay. What that really means is, the offtaker doesn't have the right to walk away whenever they like. They're saying to you, if you deliver X amount of biochar, carbon removals, etc., I will buy it. And it's also at a fixed price. So meaning, having a merchant risk on carbon credits is very difficult today because price is so volatile. Having a fixed price is very helpful. And, I've gone through high level, but that offtake contract has to be, pretty ironclad, to be honest, to finance again. So again, it's looking through, devil is in the detail, right? Like looking through the detailed contracts, making sure they work. And the other big thing for biochar specifically, as well as for DAC for that matter, is your feedstock agreements. So how do you make sure that your biochar, is generated from biogenic feedstock that is sourced robustly? We've worked with Carbon Direct and Microsoft and Stripe to draft sourcing principles for that, and it's published now as of Verge, which is fantastic. And it's very important to make sure that feedstock is not from virgin biomass, and you've ensured that that's been procured in a way that hasn't resulted in deforestation, right? Because otherwise you lose the point
Right.
of that biochar production in the first place.
Yeah.
So it's just,
That's very important.
yeah, it's making sure the feedstock is robust, and from a project financing perspective as well, making sure that feedstock supply is secured for long term, because it's no good to me if you have a pyrolyzer on site but can't source waste wood at a reasonable cost. So there are a lot of variables. That's why all these projects are so difficult to get financed, and that's why, for us it takes a long time to do both the debt and equity of these projects.
How long is a long time? Just so people can get ready. Everyone wants these processes to take place in 2 or 3 months, and that's just really unrealistic.
Yeah, it is. It is really unrealistic, and I can tell you that for some of these companies that we've just recently closed with or are closing with, they've taken like 6 months, a year, even multiple years sometimes, and we're probably one of the most hands-on in terms of banks on the street. We get involved in everything from negotiating your offtake agreements for you if they don't work, to, hammering it out with your engineers, if you have third-party engineers, and making sure that they understand what they're getting into and have the risk-sharing agreements in place.
That's incredibly helpful to founders.
That. Yeah. So, it like project development is hard. That's all I can say.
It is hard. So if I'm the CEO of a biochar company and I have realized, okay, I want to finance part of this. I have this long-term offtake agreement. I need some debt. I would imagine I wouldn't hire a financial advisor and run a competitive process to try to raise debt. Would I, or would I just directly go to you at Barclays and say, okay, we want to work with you guys? How does that process work usually?
Yeah, I think it very much is a partnership model for us rather than I'm going to do an RFP.
Yeah.
Because candidly, most of the hard work is actually around the front end rather than the back. So
what you were saying before about negotiating the offtake agreements and working with engineers. Correct. And all that. Yeah.
Correct. Most of the hard work is around the project development. And oftentimes, if you're going to FID, the battle is already won or lost. Mm-hmm. It's a fairly binary decision. You look at the materials and this is financeable or it's not. So, yes, banks can lend against that. But, candidly, there's very little value add at that point. Where I very much like to get involved is as you do your feasibility studies, we start building a relationship, right? And we start giving you a steer with regards to these are good engineering companies.
Yeah.
This is how a good engineering agreement should look like. Maybe you do a kind of, call it a FEL engineering, right? In the case of biochar, which is your feedstock engineering. Right. Study, right? And this is what a good feedstock engineering study should look like. It should be based on exactly the type of wood that you're using. Mm-hmm. Don't do a feedstock engineering on wood chips when you're using bark or forestry residue. It makes no sense, right? And that engineering agreement should ultimately end up with the engineer signing up to say, I will give you an estimate of plus minus 15%, 10%, whatever the number is, of confidence on how much this will cost and what breakdowns you will likely have and what the performance will be over 7 years, 10 years, however long the pyrolyzer should last for. And I will stand behind it, meaning that I will put my money where my mouth is. If it doesn't perform to this spec, I will pay you liquidated damages. Liquidated damages meaning that I'll pay you the difference between what it costs you to fix it versus what you thought it would perform at. And we need engineers to stand behind it as well. So you need to make sure that as you go through the process, you've negotiated all these things right. Then when you go to FID, right, final investment decision, raising equity and raising debt is easy, right, at that point, because you've done everything right.
Yeah.
And then, you can find a financial advisor and, in theory, everyone should be willing to do that. It's the front end process that's hard. And that's also challenging because, there's a limited amount of projects we can take on.
Yeah. Is this typically with the projects and companies you've worked for, Are they raising a debt and equity round together?
Oftentimes, yes.
And
so you raise some seed equity from people like yourselves to do the initial development work, right? To build maybe a small scale commercial prototype, to get to effectively kind of work on the development expenses in our terms. So again, your engineering studies, your land acquisition, your permitting process, all that kind of good stuff, practical stuff that people don't like to talk about.
Yeah.
That needs to be paid for by equity typically, and is typically kind of seed equity from people like yourselves. Then for your large, call it first of a kind or nth of a kind project, when you want to start building large scale facilities, then that's when your large institutional round of equity and potentially your debt, if it's debt financeable, comes in. That's the hard stage, and I think we've talked about this before. We call that the valley of death, because so many companies are running around trying to raise FID capital when to start breaking ground on their facilities, and it's hard because they haven't got the front end right.
Yeah. Well, hopefully they listen to this and they realize what they have to do in preparation of raising that much larger round, which takes months and months and maybe even years. Yeah, that's I think that's really helpful to know. And the fact that they can get support from you along the way before they even officially start to raise that round.
Yeah, I mean, that's why we started Sustainable Impact Capital, right, at Barclays. It's to help companies at an early stage figure things out. It's to take it's to come alongside people like yourselves, come in at seed stage, and really have a seat at the table, right? We don't do minority.
And that group is separate. That's the venture arm.
That's the venture arm,
yeah.
But that's the group that Barclays has set up just to support on these kind of opportunities. And obviously they bring us in when it's project level, right? When it's project level work, they make a decision, to be clear, independently from the investment banking group where I sit.
Yeah, there's a wall.
There's a wall between us. But when they've invested, they do rope us in to make sure that we get involved with the project development, because that's where our expertise sits, right?
Let me ask you a technical kind of boring question, because you're talking a lot about ring fencing. When you look at the corporate structure for some of these companies, is the debt being issued then at a holdco, like a holding company, or how is it structured?
It depends, but most of the time it's at project level. So when we say project level, we really mean the biorefinery level. So effectively, you set aside the biorefinery as a ring-fence entity, so the pyrolyzer and all the associated balance of plant with that pyrolyzer. You set that aside. You make that bankruptcy remote entity, right? Yeah. So separate completely from the holding company, in your words. And that cash flow is ring-fenced for the lenders. And oftentimes you put in backup servicer agreements in place, such that in the event the holding company is not able to operate the plant to spec, right, or not able to get construction done, there can be a third party that comes in to effectively substitute them to ensure that the debt can be repaid.
Yeah. So that's really important for anyone at the equity level getting involved to understand when they're making the investment.
Absolutely. It's super important because, again, equity is you're coming in and you're taking a bulk of the risk, right?
Yeah.
And that ultimately, the cash that you get back from project level is the residual cash flows after repaying the debt. That's why, debt costs significantly less than equity, because it gets paid back first.
Right. Yeah. Because it primes the equity.
Correct.
I remember you talking about companies, like a sort of a model or a typical company where you might issue debt, and you were talking about technology readiness stage. And I think I recall you saying that the debt would really come in at TRL 9.
Typically TRL kind of 8 to 9 level. And that's again where that technology would want to take on debt, because that's your first or second large scale, utility scale project, right? For commercial prototype, that's not a debt financeable proposition.
Yeah.
Because by construction, that commercial prototype is not profitable. There's no cash flows to service the debt.
Right.
But when you go utility scale, that's when it starts to get interesting for debt and for institutional investors. And that's typically where investment banks come in as well, to help structure these in the right way to get it financeable, right? Both from, again, your large institutional round. So this is, 100 million plus, 300 million plus equity rounds, and that sitting alongside that. And sometimes the institutional investor helps as well, right? That, if you have a strategic, like a utility company coming in, that's very interested in the biochar, they could provide some support to that project, both from an operational perspective. If you have, Total, for lack of better terms, coming in and investing in the company, they have operational expertise. They know how to run biomass plants, right? They have biomass combined heat and power plants today. They know how to deal with that, right? Maybe biochar is slightly different, but they have, a whole army of engineers who know how to run these things, for 10,000 hours per year.
Yeah.
And that's a key part that gives the debt lender comfort. And also from a credit perspective, it's quite important, because Total might just say, look, if said company goes insolvent, we will step in and we will take over this project, because we now have a vested interest in the project and we want to see it succeed. And that again gives the lender a lot of comfort to make sure that, it's financeable.
Do you ever see in the investment world, and especially for pre-seed and seed, we tend to see like waves of certain types of companies? I don't know how or why that happens, but there'll be a time, I remember at the end of last year, where we saw so many direct air capture companies. And you sometimes wonder, like, is everyone just starting at the exact same time? And is this just hot, or some sort of, the IPCC report came out and said, we're not investing enough in this, and then everyone just decided we're going to do that. Do you guys, in your line of work, in structured finance, do you see that too, like a wave of biochar companies coming to you, or just particular trends in the market?
Absolutely. And I think, everything in the market moves in waves, right? Like it's not just carbon removals.
We talked a lot about carbon removal today. Yeah.
We did. It's my pet topic. So
yeah, well, we need it.
Yeah, absolutely. We do need it, but that's I feel like we could spend a couple of hours on that separately.
We could. When I talk about that, I'll bring you back in.
Yeah, absolutely. But in terms of waves, yes, absolutely in waves, because that's where the public attention is, to be honest, right? Like IPCC report is a bellwether, right?
Yeah.
We do need carbon removals, and I think we're not there yet, but we're starting to gain a social license to do carbon removals, and that's important. A lot of engineers and scientists don't necessarily appreciate that, but society as a whole needs to accept that we can do this and we need to do this. It's not a substitute for decarbonization or abatement.
Absolutely
It's
not.
Complementary, right?
Yeah.
But we need it to hit net zero, because even with the best decarbonization trajectories, if you look at any of the IEA scenarios below 2 degrees, or any of the IPCC scenarios,
we don't get there without
CDR.
Yeah.
And our friend Niall McDowell, who's a great thought leader in this space, right? Imperial College professor for energy systems. He wrote a great paper on this to say, look, without CDR, we're literally twiddling as our world burns, because we have loads of these resources, like, BECCS, for example, is a pet topic I like to talk about a lot, because we have loads of forestry residue that it's literally being landfilled today that should be used in a better way. And we're not using it for bags. It's releasing methane and carbon dioxide as that wood decomposes. So we need to make sure we're using our resources in the right way. And it's, again, all these lowest cost to deliver stuff. And it's also an efficiency thing.
So part of the reason why I started this podcast is because I think there's so many players in the climate sector. There's folks like yourself, there's early stage, late stage investors, there's founders, but there's also people in policy, NGOs, journalists, people that have been following the sector forever. And I feel like we're all very siloed. We tend to sort of stay within our silo and talk to each other. And it's really important for everyone along this, within the ecosystem, to talk to one another, to get a sense for what do we really need, right? Because some of these technologies, like, there is no market yet. And so it's really important for us to understand, like, do these markets exist? Are people actually willing to pay for it? And to that end, I think we talked a lot about carbon removals, but I always like to ask, like, what are you excited about? What do you think that people need to be focused on and investing in?
That's a great question. I think there are some really low-hanging fruits.
Yes. What are the low-hanging fruit?
That we should be absolutely doing ASAP. Like, we should have done this yesterday.
Yeah.
And I'm glad you touched on enhanced rock weathering earlier in this conversation, because I think that's one of them.
Yes,
right?
Absolutely agree with that.
We have so much waste basalt.
Yes.
So much
from
waste
these
basalt.
large metals and mining companies.
Yes.
Yeah.
From road production, right?
Yeah.
And it always, like, from a systems perspective, right? Just like look at these energy systems and agricultural systems. It amazes me that we are spending so much money and so much energy and so much of our carbon dioxide budget creating lime to lime our fields when there's waste basalt right next to those same fields.
Yeah.
It makes zero sense to me how that can be a thing. So I really think that, in my opinion, enhanced rock weathering is a no-brainer, right? Whether it's for carbon removals or whether it's just for abatement, frankly, within the agricultural sector, we need to get on that ASAP, like yesterday. And we need to make sure that our politicians know about it and they are building that into policy. In the UK, the government is starting to think about that, right? Including basalt spreading as part of agricultural practices, right? Ban liming when there's a basalt, waste basalt source nearby. You should not be using precious lime that you have engineered or like you have calcified from limestone and release a whole bunch of carbon and also spend a whole bunch of natural gas heating up that calcinator, right? You should not be using that precious lime to spread on your fields to increase the pH, and you can be using waste basalt, right? There should be absolutely no reason why you should be doing that. So that's one low hanging fruit that I think everybody should wrap their heads around and start doing. And it's not just the policymakers' fault, right? It's not just the farmers' fault. It's also from a systems perspective, it's a lot of these ancient, archaic things built into our accounting systems that prevent this from happening, right? This should be using basalt should reduce your Scope 3 emissions, right? To me, again, SASB or GHG protocol might have a different view, but to me, that should be a simple way to incentivize companies to do this. Because if I'm Archer Daniels Midlands, I have Scope 3 emissions reporting, and I realize that liming my fields has X amount of Scope 3 emissions. I have to pay for that in terms of my ETS contribution. And I can simply reduce it by spreading basalt, which is a waste product anyway. Why wouldn't I do that? That seems like an easy win. So it's all these kind of archaic, kind of systemic things that, because we are so bad at systems thinking as humans, we don't fix. But to me, once you sit back and you think about it, it's low-hanging fruit. Yeah,
we didn't, when we were rapidly going through industrialization, we didn't think about how to make these processes efficient.
Yeah.
And so I think there's a lot of low-hanging fruit with areas like that.
Yeah.
Well, I have a feeling that after this comes out, there are going to be a lot of enhanced rock weathering companies that are going to be calling you.
I hope
to
so.
shoot that.
I really like enhanced rock weathering, to be honest. I'm slightly biased because we are working with, a number of them on different projects, Undo in the UK, to start scaling up. And I do think that's a CDR pathway that, ourselves and quite a lot of investors are getting very excited about because we do see this alongside biochar and BECS as one of the key pathways that is scalable, has a reasonable cost today, and will come down rapidly in the near future. And it's going to be one of the things that I would say is to watch, right? If we want to hit net zero, if we want to achieve a gigaton of carbon removals, that's one of the pathways we need to work very quickly on, in my opinion.
That's a great place to end. Thank you, Jeremiah. And thank you so much for the work that you're doing. It's so important for us to be able to access other types of financing. Equity is so expensive. So for companies to be able to scale. So thank you. And hopefully we can bring you back.
Yeah, no, would love to. Thank you for today's conversation. It was a great chat amongst friends.
And that's it for today's episode. If you found this content useful, please click the subscribe button. And if you'd like to connect with Jeremiah, click on his LinkedIn profile in the show notes. Thank you for listening, and I hope to catch you at the next one.